Hi, Chris Malouf with Cross Country Financial here with this week's market commentary. This year has been tough for investors, not just because stocks have fallen, but also because bonds have not helped to mitigate those losses as they have historically done. Below, we discuss the outlook for diversified portfolios of stocks and bonds to make the case that the 60/40 portfolio isn't dead. It may have been wounded this year and took another blow on Friday after the hotter than expected inflation data, but we believe the losses in stocks and bonds this year increase the chances of positive outcomes going forward. Long-term investors, take note. Tough year for the traditional 60/40 portfolio, a portfolio of 60% stocks and 40% bonds. Using the S&P 500 index and the Bloomberg U.S. Aggregate Bond Index, affectionately known as the AG, to represent stocks and bonds, the traditional 60/40 was down 15% as of market close on June 10th on a total return basis. If the year ended now, that loss would trail only 2008 as the worst year on record. The AG's first year was 1976. Bonds have typically seen gains during historical periods of equity volatility, although not always. But low bond yields in 2020 and 2021 and steep bond losses due to rising rates in 2022 have led many to speculate that the 60/40 portfolio is dead. But there's something of a silver lining in the declines. Recent stock and bond losses have improved valuations for the 60/40 portfolio considerably, based on a combination of the price-to-earnings ratio for the S&P 500 and the yield for the AG valuations aren't an effective market timing mechanism, but they are an important consideration for longer-term return expectations, and that picture has improved quite a bit. The time to talk about the death of the 60/40 portfolio was 6 months to a year ago, and even then it was probably exaggerated. The 60/40 portfolio may not get back to the level of returns we've seen over the last several decades, but over the last year, the 10-year outlook for the 60/40 has improved by about 2 percentage points annualized in our view, about as big a one-year improvement as we've seen at any time in the last 20 years. I'm going to give you 5 points of perspective. For many investors whose experience this year has them questioning the value of the traditional 60/40 portfolio, here are 5 things that provide perspective. Number 1, what we've seen in 2022 so far is unusual. Since the inception of the AG in 1976, the S&P 500 has been down over a calendar year 8 times. The AG was higher every single time, although only by 0.01% in 2018. Those were also the worst 8 years for the 60/40 performance. From the bond perspective, the AG has been negative 4 times in its history, the worst year being 2.9% decline in 1994. It's a small sample and isn't holding so far this year, but the S&P 500 was higher every time with an average gain of over 20%. Number 2, the picture is a little more complicated when looking at quarterly data. Since 1976, the S&P 500 has had 50 negative quarters. The AG has been lower in 16 of them. The worst quarter for the 60/40 was the 4th quarter of 2008, driven by stock losses. The AG was actually higher that quarter. The worst quarter for the 60/40 in which the AG was negative was the 3rd quarter of 1981, with the 60/40 down 7.8%. As of June 8th, the current quarter would be the 12th worst for the 60/40 overall, mostly due to prior quarters that saw heavy stock declines, and the 2nd worst for the 60/40 when the AG had a negative quarter, trailing only the 3rd quarter of 1981. Number 3, bonds can go down too, even when stocks do. Using quarterly data, the historical correlation between the S&P 500 and the AG is close to 0. Stocks and bonds tend to go their own way relative to average performance rather than moving in decidedly opposite directions. It's also important to remember that bonds, just like stocks, sometimes decline. The S&P 500 has been lower 27% of all quarters over the lifetime of the AG. By comparison, the AG has been lower 23% of all quarters, a relatively small difference. When the S&P 500 is down in a quarter, the AG is down 32% of the time. Number 4, stock valuations have improved dramatically. The forward price-to-earnings ratio, P/E, for the S&P 500 as of the end of May 2021 was 21.2% according to FactSet data. On June 8th, helped by higher earnings and not just lower stock prices, it was down to 17.4. That's an improvement of 18%, while Friday's losses bring the number closer to 20%. P&Es improve as they fall since stocks are cheaper relative to earnings. That decline translates into almost 2 percentage point improvement in the annual return expectation of the S&P 500 over the next 10 years, although many factors can strongly influence the actual outcome. Outside of earlier this year, that's the fastest one-year improvement in the forward PE since 2009. Even when the dramatic decline in PE, S&P 500 valuations are still slightly above their historical average, but the improvement is meaningful. Bond valuations have improved dramatically too. The yield on the AG as of the end of May 2021 was 1.5%. On June 8th, it was 3.53%. This is the fastest one-year improvement in yield since 1995. That likewise represents an improved annual expected return of roughly 2 percentage points over the next 10 years. There are factors that can make the actual outcome different from the expectation here as well, but the difference is less variable than that for stocks, simply because you know the price you'll get for a bond at maturity. And number 5, dislocations create opportunity for strategic investors. We've been focusing here on the S&P 500 index, perhaps the most well-known and widely used stock index in the world. But it's not the only area of the market where stock valuations have improved, and some may offer even better value. Despite its improvement, the S&P 500's PE is still in the 82nd percentile of all values going back 20 years, according to FactSet data, with higher percentiles representing less attractive valuation. But there are areas of the market that are in the 10th percentile or lower of all values over the same time frame and sitting near levels only seen during the Great Financial Crisis and March of 2020. Prospects for long-term returns for small cap have improved, for example, as valuations have dipped well below long-term averages. Similarly, there are pockets of the bond market seeing unusually high yield levels relative to the past decade. For both stocks and bonds, attractive valuations tend to be accompanied by very challenging economic conditions, but the most opportune moments often are. Where we see the best strategic opportunities is a piece for another day, but pockets of even more attractive, even extreme valuations do suggest that for long-term investors, there may be ways to further diversify a traditional 60-40. As a conclusion, recent changes in the valuation have improved the outlook for a traditional 60-40 portfolio considerably, in our view, on both stock side and the bond side. We do think of the traditional 60-40 portfolio only as a starting point for the appropriate investor. And even if the traditional 60-40 portfolio is very much alive, as we believe, there may still be opportunities to improve the risk profile of a portfolio, whether through greater diversification within stock and bond holdings, active management, or investment opportunities outside the traditional stocks and bonds. So far, it's been a tough year for many investors, and we don't think we're in a position yet to call a tactical bottom for either stocks or bonds, despite last week's losses. But looking out strategically based on better valuations and still mostly favorable fundamentals, we think the long-term outlook has brightened quite a bit. If you found this information beneficial, hit that subscribe button, invest early and often, and we'll see you next week.